The global energy landscape shifted dramatically today, as crude oil prices entered a state of extreme turbulence. Following the sudden announcement of a 2-week ceasefire between the US and Iran, the market reacted with shock. In the early hours of trading, oil prices witnessed a historic collapse, plunging by nearly $20 per barrel. This initial relief sell-off was driven by hopes that the intense geopolitical pressure in the Middle East would finally ease. Investors quickly moved to liquidate war premium positions, betting on a swift return to diplomatic stability. However, the euphoria proved to be short-lived as the reality on the ground became increasingly complicated. Reports of fresh military strikes in Lebanon began to circulate shortly after the ceasefire news broke. These reports reignited fears that the conflict could still expand despite the temporary agreement. Furthermore, the strategic Strait of Hormuz remains closed to commercial traffic, causing massive logistical bottlenecks. Because this waterway is a vital artery for global oil supply, its continued closure acts as a hard floor for prices. By midday, the initial price drop was almost entirely erased, as traders rushed back into long positions. Brent crude is currently hovering around $97 per barrel, showing the market's deep-seated anxiety. Analysts suggest that traders are staying skittish because the peace deal lacks a verified enforcement mechanism. Without a clear path to reopening global energy choke points, supply remains artificially constrained. The volatility has also impacted the shipping industry, with insurance premiums for tankers reaching record highs. Refiners are struggling to price products as the raw material costs fluctuate by double digits within hours. Major economies, particularly in Asia and Europe, are watching the situation with bated breath. A sustained price above $90 is seen as a significant threat to global inflation targets and economic growth. The U.S. administration is reportedly under pressure to provide more clarity on the terms of the truce. Meanwhile, Iranian officials have remained vague about the timeline for de-escalating naval presence in the Gulf. This lack of transparency is fueling skepticism among institutional investors and hedge fund managers. Technical indicators show that oil is currently in an oversold state, leading to frequent dead cat bounces. The 200-day moving average is being tested repeatedly as the market searches for a new equilibrium price. As the day draws to a close, the focus remains on whether the ceasefire will hold through the night. Any further military escalation could easily push prices back above the $100 mark by tomorrow morning. Conversely, if the Strait of Hormuz shows signs of reopening, we could see another massive downward correction. The roller coaster session highlights how sensitive the modern economy is to singular geopolitical events. For now, the trading floors remain on high alert, bracing for the next headline that could shift the tide. Energy stocks have also mirrored this volatility, with major oil companies seeing wide swings in valuation. The 2026 energy crisis continues to be the primary driver of global market sentiment and uncertainty. Every tick in the price of Brent crude carries heavy implications for transport, heating, and manufacturing costs. The world is witnessing a masterclass in how fragile global supply chains truly are. In the face of conflict, traders are advised to maintain tight stop-loss orders to navigate these unprecedented price swings. Ultimately, the Iran ceasefire is being viewed as a fragile bridge rather than a permanent solution. Until the tankers start moving freely again, the war premium will likely remain baked into every barrel. The next 48 hours will be critical in determining the long-term trend for the second quarter of the year. For today, the story is one of missed opportunities, high-stakes gambling, and a world on edge. The ceasefire effect has turned out to be a lesson in market psychology and geopolitical skepticism. No one wants to be caught on the wrong side of a trade if the peace deal collapses tonight. Therefore, the $97 level is being guarded fiercely by both bulls and bears in the current environment. It is a waiting game that has the entire financial world holding its collective breath. The volatility seen today will likely be studied by economists for years as a case of extreme sentiment. As we move into the weekend, the risk of gap up or gap down openings on Monday remains exceptionally high. Investors are shifting focus towards safe haven assets like gold as a hedge against oil price unpredictability. The narrative of 2026 continues to be defined by the intersection of energy security and international diplomacy. Every headline is a potential catalyst for a billion-dollar move in the global commodities market. Stay tuned for further updates as the situation in the Strait of Hormuz continues to evolve. The oil market has proven today that it is far from finding a stable bottom. The roller coaster ride is far from over for the world's most essential commodity. Volatility is the only certainty in the energy sector as of April 9, 2026.